Good morning, this is Claudia. So today I want to talk about growth stock versus value stock and what the difference is. I'm sure you have heard of Warren Buffett being a value investor, and uh, and then other people are growth investors. And of course, you can do both. But Warren Buffett buys value stock, and the name value is from they're on a lower, they have high value, but they're on a discount right now. So he buys stocks that are on discount right now. Um, he's buying large amounts of Occidental Petroleum right now. And, all these people have to disclose their trades and their investments, which is kind of cool. And so you can see where they're going in and what they're doing with it. However, so value stocks are traded lower at the time. And that's when investors come in and they buy that. And the reason why they buy that stock is because, companies like Coca-Cola have been around for a very long time. Look at back in history, they're like 100 years old. And so they buy those on discounts, and of course they're buying large amounts. And then they get dividends, they get paid dividends on all these stocks, which is kind of cool. So you're actually making money on the stock's growth, even though value stock grow a little bit slower. They grow by 7% per year average. And but they also make money through dividends, and dividends usually increase time over time to compensate for inflation. So that's kind of cool. Now, growth stocks grow much faster. They grow 15% per year. And of course, there's a lot, and it's not guaranteed. Not all growth companies grow that much, but one of the growth companies could be like Tesla. And in the past, when you look at the last 10 years, Tesla made people rich, and just because of the high growth. So they still have a long way to grow and to increase in value. And most growth companies, not all of them, but most of them don't pay dividends. So you're mostly just making money on the increase in price of the stock. But growth companies are large companies with a high PE ratio, price to earnings ratio. And in any portfolio, you always want to be well diversified, just in case, and so that you don't have these crazy fluctuation in your portfolio, which makes everyone nervous. In general, every investor is looking for a lower price to get into a stock, get into a company, because when you're buying stocks in a company, you're buying a small percentage of that company. So make sure that you always know what you're investing in. You do your research, but also it doesn't matter if it's a growth stock or if it's a value stock. If you can buy a very good company that you researched on discount and you can write them up, then that's all you need. But any investor has a well diversified portfolio. The average return of the S&P 500 is, I think, 7 or 8%. But of course, long-term investors will make money on compound interest. So you're getting interest paid on your investments, and the next year you're getting paid interest on the interest of your investment. So compound interest is coming in. So with any stock portfolio, make sure that you're well diversified. Don't buy into anything that you don't know. But the difference between value and growth stock is the amount of percentage they grow if every year, 7% versus 15%. And uh, and paid dividends. Many growth stocks don't pay dividends, but value stocks, a lot of value stocks do pay dividends. But yeah, just be diversified, know what you're investing in, and don't be stupid. Don't invest in new companies. Don't invest in something that some YouTuber tells you to invest in. But I hope that you like this little video. Very short. My goal is just to, specify some of the terminology. When you start first investing, there's a lot of, you have a lot of questions, and it takes a long time to answer all this. So I'm trying to make it easy on you. I just like to give a little bit value. When I started investing and I researched the stock market, option tradings came up first, and the problem with that is that you should always start investing long term first because that's your winner. When you're investing and when you're trading options, especially in the beginning, um, you can make great returns, and most of the time it's just luck. And but you can also blow your whole account. So long-term investing is a safer way. There's still risk involved, but it's a safer way to invest in the stock market. Nobody gets rich by tomorrow. It doesn't matter what kind of guru tells you that. You don't get rich by tomorrow. Growth and wealth is being developed over time. So stay patient, and I will see you in the next video. So thank you so much for joining this YouTube channel, and I'll talk to you soon. Bye.